Hi, good afternoon on the East Coast, good morning on the West Coast, and everywhere in between. My name is Lacey. You're listening to the fourth webinar in our series of 4 on unraveling the proposed bar defense rule. This webinar focuses on the repayment rate, the proposed repayment rate, I should say, for proprietary schools. Please remember that if you are listening to this webinar right now and it is some point after the original air date, right, so you're listening to a recording. If that's the case, please keep in mind that law and guidance may have changed, and in fact, you know, these webinars are all about a proposed rule by the Department of Education. Our strong expectation is that the final rule will be published either October 31st or November 1st. So after that point, you'll have the final rule to be concerned with, and I think I've already mentioned we are still planning to do another round of a series of webinars on the final rule after they come out, when we're targeting somewhere, it looks like, in late November, early December, sort of between the Thanksgiving and winter holiday season. I mentioned at the outset, my name is Lacey. I'm a partner in the higher education practice here at Thompson Coburn, LLP. This is a law firm, and I am a lawyer, right? And Thompson Coburn is about 400 attorneys strong. We have offices in 4 or 5 locations in the United States, so we're a fairly big firm. Our higher education practice, of which I am a member, does a lot of different things, but the regulatory aspect of the practice I like to divide into sort of 3 buckets. We provide regulatory counsel on federal, state accrediting agency laws and standards, so all those types of laws that are specific to higher education, like Title IV federal financial aid, Title IX, the Clery Act, those types of things. We assist with lots of different types of transactions and contract drafting and negotiation, and we spend a lot of time helping folks develop policies and compliance systems. So we take into account all those regulations, things like the ones we're talking about today, and we'll sit down with folks and say, what kind of internal policies do you need? What kind of external policies do you need? What kind of forms and disclosures do you need? And we'll help them get all that in order. Finally, we also represent institutions in student and employee litigation, so we actually have a pretty active post-secondary student and employee litigation group, and we also do government investigations. That would be like AG investigations, things like that, and administrative proceedings, and that's one of the things I do personally, where if someone, for example, had an issue with the U.S. Department of Ed program review or an audit or something like that, you know, I would assist them in dealing with the department. Okay. Just briefly, I'll mention, before I was here, I was with in-house with a post-secondary institution for 4 years, and then before that, spent about 8 years in another law firm in another post-secondary education practice group, so have been in the higher ed space my entire career. Here's the webinar series schedule. Again, we're doing the last one today, and you can see the prior 3 that we did and the dates that were available, and we'll be sending out that email in the coming weeks that has all of these webinars on demand for you. Today's presentation outline, so as always, I want to just take a minute to talk about the current rulemaking, give you some context for what we're talking about here. Then I want to talk about the proposed repayment rate framework, so sort of the whole thing. Then I want to zero in on the proposed repayment rate calculation. And then lastly, I want to talk about, you know, the department's policy discussion, you know, the justification for another repayment rate. So the rulemaking timeline, the current rulemaking began, really, it was first announced last fall. In late 2015, the department said, hey, you know, we want to create some new rules around the bar defense idea, and then also a number of other ideas as well. And then between January and March, they convened a group of stakeholders and had 3 different meetings. These were the negotiated rulemaking committee meetings, and they talked about the rules and what they ought to look like. The people at the table had a lot of different opinions, which was expected. So at the end of those 3 meetings, there was not any sort of consensus or complete agreement on what the rules ought to look like. And under the way the department's protocols work, that pretty much frees the department up to draft the rules in the way that they see best although they typically take into account much of the feedback they've received during the negotiated rulemaking. On June 16th, having taken all that into account and wrapped it up, the department produced its proposed rules. On August 1st, the comment period closed, so between June 16 and August 1st, folks had an opportunity to discuss and provide post comments. There were a little north of 10,700 that were posted to regulations.gov and comment to this proposed rule. Our expectation is that the final rule will be published November 1. Actually, thehill.com indicated yesterday in a brief story that the department has actually sent its draft of the regulations over to the White House and the Office of Management and Budget. So they are on the move. And we do very much expect that you'll see a final draft. Again, usually October 31st or even November 1st. I think it's going to take them all of the time in between to get these finalized and to work through certain issues with the White House and OMB. But it is almost certain they will target getting them done by November 1 so that they can ensure that they become effective by July 1, 2017 of next year. We have been referring generally to this rulemaking, as has the press and others, as the borrower defense rulemaking, but it actually covers a lot of different topics, and that's the purpose of this slide, is to sort of give you a sense of all the different things that are part of this. Of course, you have borrower defense, which is the headliner, but there are components relating to financial responsibility, arbitration agreements, closed school and false certification discharge. And then finally, you see in the lower right-hand corner, highlighted red today, repayment rates for proprietary schools. Now the thing that is unique about today's webinar and the topic is this is the only topic that is clearly and explicitly applicable just to proprietary schools. There are elements of all of the others that as a practical matter will likely only impact the proprietary school sector, although all the others also have the potential to impact everyone else, and at least as a matter of law on its face, they apply to everyone else. But this piece we're talking about today is limited, at least in the way the department has proposed it, to the proprietary school sector. All right, so let's talk about the proposed repayment rate framework. The idea is that for each fiscal year, the department would calculate a new and different from any other thing that you are currently aware of, a new loan repayment rate. And we're going to talk about later the fact that the department already has a couple of different repayment rates out there. This is a new one. If the rate is less than or equal to 0, then the institution must disclose a warning. Right? And the warning has to go to prospective and enrolled students. It has to be prominently placed on the website and in social media, although the department concedes in the preamble and commentary that that piece, the social media piece, will have to be worked out. They don't expect you to include it every time you post something on your Facebook page. So, you know, more discussion forthcoming on that one, but certainly on your home page, prominently first page of your website, and in all promotional materials and advertisement. And as you all who deal with the gainful employment regulatory framework and sort of the requirements there know, the department takes a broad view of what constitutes promotional materials and advertisements, but also has tempered that requirement over the years with an understanding that certain type of media, radio spots, things like that may not provide for full disclosure. You might have to somehow modify the disclosure in a way to fit within that particular type of marketing. So this is really it. They're going to calculate a new rate. If the rate's less than or equal to 0, you have to make the disclosure. That's the whole concept. This isn't nearly as complicated as some of the other things we've talked about, at least not the framework. The warnings have to be made within 30 days of an institution receiving its final rate determination. And the department has said they will determine the form and content. I mean, they're authorized to do that. That's how the law works. They have not yet put that out. It would probably be provided in the Federal Register through an announcement. But they did, in the commentary, offer up examples of the kind of language they might be thinking about. This is in the commentary to the proposed rules. So they said, you know, something like one of these, U.S. Department of Education warning in every case, right? And then you've got this colon, and after that, you've got slight variations. So a majority of borrowers at this school are not likely to repay their loans, or a majority of borrowers at this school have difficulty repaying their loans. So certainly the kind of language that if you're providing it to prospective students, there's a very real likelihood that it will impact their decision or may impact their decision to enroll. And that is the idea, by the way, and we'll talk about that later. Institutions would have an opportunity to review the cohort list. So if you've been paying attention to the way the gainful employment framework works, you're going to start seeing a lot of similarities as the department is sort of conceptualizing and rolling out new regulations, they are borrowing from or building upon some of the ideas that they've introduced in prior regulatory schemes. So here, just like in gainful employment, you have this completers list. That's the list of the students in the cohort that institutions get to look at and review. Here again, for purposes of this repayment rate, there would be a mechanism by which the department would send you the list of names for the individuals they think are in this cohort that they're going to use, the borrowers they're going to use to calculate your repayment rate. And you would have a chance to look at that and provide feedback. And here again, the department has made exceptions of where you have very few borrowers, for example. So you'll see this bullet: an institution with 10 or more borrowers that receives a failing repayment rate would still have an opportunity to appeal if its rate, if the institution can demonstrate that it has a low participation rate under the direct loan program. And this is very similar to a type of appeal you can file if you have a failing cohort default rate. Anyone on the line who is involved in that process occasionally will recognize that. So you've got a participation index concept here, and essentially what you're trying to show is even though you may have a fair number, more than 10 borrowers with direct loans, that you nonetheless have very few people who actually participate in the direct loan program when compared to your student population. Also, the department would simply not calculate a repayment rate for an institution if they have a cohort based on fewer than 10 borrowers. So it has to be 1 through 9, right? But if you have that small a number of borrowers, then the department won't even calculate the rate. Okay, so that's the framework. Now I want to really zero in on the proposed repayment rate calculation itself, the methodology, how this calculation works. You know, the devil is in the details, and I think there are some concerns here, and it's worth really trying to understand how this thing would be laid out. The rate calculation. All right, so the department would calculate a loan repayment rate each fiscal year. Each fiscal year, that's the federal fiscal year, right? So that starts October 1, goes through September 30. For each fiscal year, they would calculate a loan repayment rate for the entire institution. So this is not a program-by-program calculation. You know, the whole gainful employment framework is built on program-by-program analysis. That's not the case here. This is an institution-level number, right? So it's like your student right to know graduation rate or your cohort default rate for your institution. It's at the institution level and presumably at the level of the OPID, across the whole OPID, right? The rate would be for the cohort of borrowers whose direct loans entered repayment at any time during the 5th fiscal year prior to the most recently completed fiscal year. Now, I know that is a tongue twister, so let's look at a picture. That always makes it a little bit easier. So again, the fiscal year, remember, runs from October 1st to September 30. That's the federal fiscal year, and in this proposed rule, they've made it very explicit that that's how fiscal year would be defined. And it's identified by the year in which it ends, right? So fiscal year 2017 covers the fiscal year that ends on September 30, 2017. So on the far right here, you see I've got fiscal year 2017, and I did that on purpose because if these regulations become effective July 1, 2017, right, then the first fiscal year that would end following the effective date of these regulations would be the fiscal year that ends September 30, 2017, so FY 2017. So if they are trying to calculate the repayment rate for the first time at some point in 2018, right, then the most recently ended fiscal year would be FY 2017. So the next question is, well, what's the 5th prior fiscal year? And you see in the chart, you can just march backwards, right? The first prior, second prior, you go all the way back. So it would be the fiscal year 2012, right? So in this example, in which FY 2017 is the most recently completed fiscal year, which I'm going to assume it would be if the department's trying to do this for the first time in 2018, the department would calculate the repayment rate based on borrowers whose direct loans entered repayment at any time during FY 2012, and that would be between October 1st, 2011 and September 30, 2012, right? So in years to come, you can just look at this chart if you wanted to, and you can sort of plug in the new numbers, but this gives you a sense as to how you would figure out that cohort period. All right, so the department would exclude from this group, this cohort, any borrowers who fit one of the following categories, right? So if they were in a military-related deferment status during the last fiscal year of the applicable period, right? So remember, if we're talking about, let me just jump back to this prior slide, the applicable period would be between September 30, 2012 and September 30, 2017. That's the 5 fiscal years of the applicable period, right? So if you had someone who was in a military-related deferment in the last fiscal year of the applicable period, FY 2017, they would be excluded. Now, if they were in a military-related deferment, let's say in FY14 and FY15, they would not be. And this is an important point. We'll come back to this in a minute. But they're only excluded if they were in a military-related deferment status during the last fiscal year of the applicable period. If one or more of the borrower's loans are either under consideration or have been approved for a discharge on the basis of total and permanent disability, and that is not tied to any particular period. If the borrower was enrolled in an eligible institution during the last fiscal year, again, of the applicable period. So if they were enrolled, in our example, in another school during FY 2017, they would be excluded from the cohort. And finally, if the borrower has passed away. Right? And there's a couple of things I want to point out here. One I've already hit on, and that is the idea that in some instances, if someone has been in a deferment status, right, and so the idea is they haven't been repaying on their loans, right? If they were in that deferment status in that last fiscal year, they would be excluded from the cohort. But again, that's only in the last fiscal year. So you could have a situation where someone was on deferment, legal deferment, you know, approved by the department for a period of several years, 3 or 4 years during that 5-year fiscal year window, and they're still being taken into account and included in the cohort, which could be problematic if they weren't paying on their loans, right, during that 4-year period. They could end up in a state of negative amortization, and we'll talk about that in a minute too. The other thing I want to note is that every type of deferment is not listed here. So, for example, if someone was in a deferment for a period of years for economic hardship, doesn't matter, right? They're still included in the cohort. Right. So this is like with the gainful employment regulatory framework, you know, they've come up with bases for exclusions, and presumably the thinking is, well, in some of these cases it would be unfair to include these folks in the cohort because obviously if they passed away, they're not going to be able to repay their loans. But also if they were in a deferment at some point, you know, they might not have been repaying on their loans. But it's not comprehensive. It doesn't include every type of deferment. Right? And it only includes people who are in certain deferments during certain periods. Okay. So for each borrower that is included in the cohort, so you run those exclusions, you come up with the people who are actually in the cohort, right? For each one of those folks, the department's going to calculate the difference between the borrower's current outstanding balance and the borrower's original outstanding balance. So what we're trying to tell here is, you know, what did they owe at the time that they went into repayment? What do they owe now at the end of this 5-year period? And what's the difference between the two? And clearly what the department's trying to get at is, have they made any progress paying down their loans? So here's that equation, OOB minus COB, right? Again, that equals the difference. Just so you know, because it's important to, again, the devil's in the details, the original outstanding balance is defined in the proposed rule as the balance owed, including accrued interest, at the time the borrower first entered repayment. The current outstanding balance is defined as the balance owed at the end of the most recently completed fiscal year. So for our hypothetical, if we're talking about FY 2017, that would be the amount that they owed as of September 30, 2017, right, including capitalized and uncapitalized interest. So those are the two numbers that the department is going to be using to come up with this difference. All right, now take a deep breath because I'm about to really get into the weeds with you. For each borrower, after the department generates this number, they're going to run this little calculation, right? So they've got this difference, okay? Then they're going to express the difference as a percentage reduction of or increase in the original balance. So they want to figure out what kind of progress you've made on repayment, and they want to figure out, secondly, to what extent does that represent a percentage reduction of or increase in your original balance. Then they're going to convert the percentage, that percentage, into a positive or negative value, right? Positive for percentage decreases. So if you've managed to pay down from your original balance, you have a positive number. Negative for percentage increases. So if you've actually got a higher balance now than you did when you entered repayment, right, that's represented as a negative number. For defaulted loans for which there is a positive value, that would be treated as a 0, right? And this is an interesting idea that the department's come up with, but basically what they've said is, let's say someone's, you know, on a, you're talking about 5 years, right? And for 3 of those years they were making good payments, and then they defaulted on the loan. It may be that at this point, what they owe is still less than what they originally owed. So they actually managed to pay down half the loan. Let's say they started at $10,000, they made payments for 3 years, they got it down to $5,000, then they went into default. Right now they're in default. The department says, okay, if we do the calculation and it turns out that the difference shows that they've made progress in repayment, but they're now in default, right, that's going to be a positive value because they've paid it down, but we're just going to give them a 0 because they're in default. So it's sort of treating it as a wash, right? Now, if they're in default and they have a negative value, in other words, if they owed, you know, $10,000 when they went into repayment and now they owe $15,000 and they're in default, it's just a negative number. You don't get, it's not sort of a wash, you don't get a 0, you just get the negative number that would go along with it, like anybody else who owed money, who owed more at the time their COB is higher than their original balance. Okay, so that was a lot. One last piece, and then I'm going to show you a chart that's hopefully going to make it a little bit easier. So after the department has calculated these numbers, they've got these positive and negative values for each borrower. They're going to put all those values, they're going to plot all the values in the cohort. Now, you know, this will be done by a computer, but sort of if you imagine it in your mind, imagine a spreadsheet, you're going to have all those values, right? And then you're going to determine the median value. Again, if you've done gainful employment, you're sort of seeing the echoes of that here. The median value would be the institution's repayment rate. So that's how they calculate your repayment rate. And if that median value is less than or equal to 0, the institution must make the aforementioned warning. All right. So let's walk through this. Let's see how this looks in a practical example, right? So I've got here a chart. I've got 7 students that I've come up with for our institution, and all the numbers are made up to make the math easy, right? So for the first student here in our first row, this person's in an active repayment status. They are making repayments on their loans, and their repayment program is standard. You know, by that I mean they've just got a good old-fashioned make a payment every month type plan. Their original balance when they went into repayment, right, 5 years ago was $12,000. Right, as of September 30, 2017, their COB was $10,000. So they've paid down $2,000 on their original balance. That's the difference, right? As a percentage change, it's 16.67%, or about 17%, right? So they've paid down about 17% of their original balance. So the assigned value, when you convert that, right, you get a positive number. It's 0.17. You could just as easily call it 17. I don't know how the department will do it, but the salient point here is it's converted into a positive assigned value, and in this case, I'm calling it 0.17. So the second row, exact same thing. We'll just say that's a second student who's done the same thing. They went into repayment same time, standard payment plan. Again, they've got an assigned value of 0.17. Now, our third student is in an income-driven repayment program. Sanctioned by the department, promoted by the department, right? But what that means is they're making payments based on their income. So they're making pretty small payments every month. So this person had an original balance also of $12,000. In fact, they all did. But at this point, they owe $13,500. Now, they are in active repayment, but the payments are so small, right, that the interest is accumulating faster than they can pay down the principal. So the total amount they owe is actually going up. That is, by definition, when I say a state of negative amortization, that's what we're talking about. We're talking about a situation where the principal is gaining interest faster than the person can pay down that principal, right? So even though they're making active payments, the total amount they owe on the loan is actually going up, right? So this person, line 3, is in an income-driven repayment plan, but they are in a state of negative amortization. So the difference when calculated between the balance they owed when they went into repayment, that $12,000, and what they owed September 30, 2017, is a negative $1,500. They're actually in the hole $1,500 more than when they went into repayment. So that percentage change is negative 12.5%, right? Because, again, it's actually a greater percentage, right, from their original balance. So the assigned value is a negative, in this case, rounded, a negative 0.13, right? The next person is also in active repayment, okay? and this person is in a standard repayment program, but they deferred the first 3 years following repayment because they went to further education. So they graduated, and again, I'm just making all this up, but let's say they went for 3 years off to graduate school and they got another credential, and so they were deferred during that period. So their original outstanding balance when they entered repayment was $12,000. Right, but as a consequence of the deferral, et cetera, they're now at $14,000. Okay, and again, I'm making all this up, but we're trying to illustrate a couple of points here. So the difference, once again, is negative, right? They are in a state or at least they have a negative balance at this point, with the percentage change of 16.67, so they've got an assigned value of negative 0.17. The next person's standard, but they deferred 3 years because of economic hardship, right? So they're in inactive repayment. They're not on any special type of payment plan. They're just making regular repayments. But they also have a greater balance as of September 30, 2017 than when they first entered repayment, right? So they've got a negative $4,000. That's a negative 33% change. And so, again, they have a negative assigned value. And then lastly, we've got two people who are in default. The first has an original outstanding balance of $12,000, and they managed to pay down $1,000 before they went into default, right? Or at least they paid down some amount so that as of September 30, 2017, they had still paid down net $1,000. Difference is a positive $1,000, but because this person is now in default, they are assigned a 0. Remember, that's that one little special provision. And then the last person's just in good old-fashioned default. We'll say they went into default right after they graduated. They owed $12,000 then. They owe $17,000 now. They, and that's a negative number that they're going to get. And again, those numbers are made up, obviously. But the point I'm trying to illustrate is this, three things here. The first is, if you look, you've got out of these 7 people, 5 of them that are in active repayment statuses. So those 5 people have at some point, they've always either been on a sanctioned deferment or they have been actively repaying pursuant to some form of sanctioned departmental repayment plan, whether it's income driven or standard, right? But of those 5 that are in active repayment, only 2 of them have a positive assigned value. The other 3, for various circumstances, have a negative value, right? One is in negative amortization because they're on an income-driven repayment plan and they're not making payments fast enough to overtake the interest. Another one had an approved deferral, right, for further education, but, and this is the point I meant to make a minute ago, that person wasn't deferred during the last year of the fiscal year. So that's why they're not excluded from the cohort. They're included in the cohort because in the last year of the fiscal year, they were not in any type of deferment status, right? They were in that further education deferment, but it was for the first 3 years of the 5-year period, not the last one. And you only get excluded from the cohort if you're in that deferment status during the last year, right? And then this other person who's on economic hardship, that's not one of the approved under the proposed rule statuses for which you would exclude someone. Right? So all of those people are included in the cohort. 5 of the 7 are in active repayment, but only 2 have a positive assigned value. Right? So the median for this group of 7, despite the fact that you've got 5 out of your 7, and you could blow this up, you can multiply it times 100. You could have 500 out of 700 students who are in active repayment. Right? But the median here is negative 0.17. So this school has what the department would consider a 0 or negative repayment rate and would have to make the warning, again, despite the fact that the majority of your individuals are in active repayment and have all been in some form of repayment pursuant to a sanctioned departmental program. All right, so points of significant concern. Well, I've pretty much just articulated one of them. An institution with very high percentages of borrowers in active repayment and making payments pursuant to a government-approved program could be determined to have 0 repayment rate, right? Which would seem to be misleading because you're being told that you have to tell students that you have a 0 repayment rate, and you've seen the proposed warnings that the department suggested in the commentary. Presumably, a prospective student who read one of those warnings would think that the majority of your students are not actively repaying their loans. Whereas in the illustration we just saw, you could actually have a situation where the vast majority of your students are actively repaying their loans. So you have the potential here for what you could call a misleading statement or misrepresentation if you want to go in that direction. The proposed rule only accommodates certain types of deferments and then only during certain periods. I mean, clearly that's a concern, and the department has not articulated why that is the case. Obviously, they think if someone is in a military-related deferment in the last year of the fiscal year, you know, that's, I don't know what the nexus is to when you're making the calculation, if it has something to do with that, but for some reason they feel like it's appropriate to exclude that person. What's unclear is why they would not think it was appropriate to exclude someone who was in a deferment, say, for the first 4 years of the 5-year period, right? And there may be good reasons for that, I should say. I'm not suggesting there aren't. I'm just suggesting that that has not been articulated, and it's a point of concern. The proposed calculation equates a state of negative amortization with a state of non-payment. This is a significant concern for me. First of all, I think this is factually inaccurate, right? If someone is actively repaying their loans in an income-driven repayment plan, that is not only sanctioned but promoted by the department, right? That is not the same as that person being in a state of non-payment. But when you call this a repayment rate, and then you penalize folks for individuals who are choosing an income-driven repayment plan and as a consequence are in a state of negative amortization, you get to the prior concern, which is that you're ultimately misrepresenting to students because you're requiring the institution to tell prospective students our borrowers are not repaying their loans, and that's not accurate. Right? What may be accurate is a majority of our borrowers aren't making enough that they can adhere to a standard repayment plan, and as a consequence have elected income-based, income-driven repayment options. But that's very different from telling them flatly that your individuals or students are unlikely to be able to repay at all, right? Penalizing institutions for borrowers who take advantage of repayment programs created and promoted by the department certainly seems unfair, right? It would be one thing if the department, and what's interesting is in the Federal Register accompanying the proposed rules, when they talk about the repayment rate, they state explicitly that the increased levels of negative amortization among borrowers are a concern. I don't disagree with that. In fact, I think they are a concern. But it seems quite clear that the reason you have an increased number of individuals in negative amortization is because you have created and promoted income-driven repayment plans. If negative amortization is a major concern of the current administration, or at least the department, then it would seem that the appropriate solution is to reconsider whether you want to make income-driven repayment plans available, right? But penalizing institutions by creating this inaccurately described repayment rate and then requiring them to make disclosures would seem unfair in the extreme. So let's talk more broadly then about what the department is thinking here and what is their justification for this repayment rate. Just as an initial matter, the statutory authority they cite for this whole thing is just their general authority to, and I quote, prescribe such rules and regulations as the Secretary determines necessary or appropriate to administer and manage the functions of the Secretary or the Department. You know, the Department does a lot of stuff under this extremely broad grant of authority, and I would not suggest that you would get very far if you tried to argue that they did not have the authority to require disclosures and rates and things of this nature pursuant to this statutory grant. But what I want to point out here is there is not statutory language from Congress saying we want you, Department, to create a repayment rate. Right, that does not exist. So the department is just citing its general authority to administer the programs in a way that is appropriate and necessary. So within that sort of mandate, the department is arguing here, and the logic is fairly straightforward. The department is arguing that students should make as informed a decision as possible when they are deciding to enroll. Fair enough. I doubt many would disagree with that. And they are further arguing that the repayment rate warnings will assist students to do that. So the need is that students need to make informed decisions, right? And the purpose of the repayment rate is to help them make those informed decisions. And that's essentially the justification. Breaking down their logic a little further, it flows like this. So students need to know more specifically if it is likely that they're not going to be able to pay down their loans after graduation, right? So if there's a likelihood they're going to be unable to pay down their loans, that's a piece of information they ought to have before they enroll. The department has conducted it has told us, analysis of NSLDS data, that indicates that the typical borrower in negative amortization or in a state of negative amortization will have trouble paying down their loans after graduation and is more likely to default. And, you know, they didn't provide this data, but that seems quite likely, right? I mean, if you've got folks who are underwater and the interest is growing, it does seem very reasonable that those folks would, on average, have more trouble paying down their loans and ultimately might be more likely to default. Then the department takes the position that institutions with high numbers of graduates in negative amortization and default will have or be more likely to have a zero or negative loan repayment rate under the proposed calculation. Well, that's also likely true, right? Because we just talked about how the calculation works, and it essentially penalizes institutions if they have a high number of individuals, certainly in default, but also in a state of negative amortization, even if they are actively repaying on their loans. Institutions with zero or negative loan repayment rates under the proposed rule will have to make warnings, and the required repayment rate warnings will thus alert students of the likelihood that they will be unable to pay down their loans. So you see how the logic comes full circle. Using this logic, the department then concludes that the repayment rate would be useful and new information to students. All right, so point of concern here. There is no question that the new repayment rate would provide different information from what is presently being provided, but it is unclear whether this would be useful, right? I mean, it is my view that a borrower is not going to find information such as a new repayment rate useful unless she understands the methodology underlying the rate and more generally how it's different from all the other rates that schools already calculate and disclose. Right? I mean, if you can't find something useful if you can't understand it at all. It might be misleading to you if you don't understand it and you just take it on faith when someone says, well, this is what this rate means. But if you really want to understand the rate and find it useful, you've got to understand, one, how it works, and two, how it's different from all the other stuff that you're being provided. And there are many other rates. First of all, in the commentary, the department openly acknowledges that it already calculates 2 other federal repayment rates, one for the college scorecard website and one pursuant to the gainful employment rule, and that both of these rates are calculated pursuant to different methodologies from the new proposed repayment rate. So there is already acknowledgement from the department that it makes available and or requires institutions to calculate and make available 2 other repayment rates that are completely different. So you've got a situation where in the least a student's looking at 3 different federal repayment rates, and maybe you have a state or even an accreditor, though I'm not aware of one yet, that requires some sort of repayment rate calculation, right? So you could have even more than 3 conceivably that you're being required to provide. But let's take a broader view. In addition to those 2 other repayment rates, the department also calculates, reserves the right to calculate, or requires proprietary schools to calculate the following. It says calculate the following. I think that's a misspelling of my part. So you've got your student right to know grad rate on time, your student right to know grad rate 100% overall. You've got to take the student right to know grad rate and disaggregate it, and that's both for the on-time and the 150%. You've got your transfer out rate, retention rate, completion graduation, transfer out rates for student athletes, if you are subject to that requirement. And then under the gainful employment, you've got a completion rate, a withdrawal rate, 100%, a program court default rate, right, a withdrawal rate, 150%, annual earnings rate, discretionary income rate, placement rate for the institution. If you have one, you have to disclose it, right, and then a placement rate by program that you're required to calculate. So when the department says this is useful, it is certainly different, but one of my concerns is, how are students even going to begin to understand the purpose or meaning of this rate as compared to, or when, presented in the context of all these other rates? There would seem to be, in my mind, indeed, a bigger question that this is really raising regarding the usefulness not only of this rate, but all of these rates taken together. And, I certainly have encouraged the department and other regulators, it's my view that it would be really beneficial to schools and students to sit down and say, what's really meaningful here, and let's try to winnow these down to the handful of numbers that we think provide the best information. You know, I look at all those rates on the prior screen and the 3 different repayment rates. Not only do I think that students are going to be unable to tell those apart or understand the meaningful distinctions between them, you know, I would suggest I don't think there are 25 or 30 people on the planet who right now, off the top of their head, could sit down and tell you how all those different rates differ. And that includes at the Department of Education. And that's not trying to be glib or disrespectful. It's just a fact that it's very complicated. It also increases the likelihood that institutions and their, you know, admissions and other employees who are making representations to students are going to get confused and potentially say something that's inaccurate, not with any ill intent, but just because it is all so dang complicated. So I think there's a real concern here. You know, I will say the department has recognized that this additional rate is, you know, just sort of one more that's out there, and they said, well, we're going to try to harmonize the new repayment rate with all the other rates. But I think that there's a lot of work to be done there. So the first question is, you know, we were talking just then about the idea just justifying a repayment rate in general. The other question that, of course, I know the proprietary schools on the phone have been asking is, well, what's the justification for only applying this to the proprietary sector? So interestingly enough, it's administrative burden. Recognizing the administrative burden the new framework creates, and this is in the Federal Register, the department has proposed to only apply the rule to the sector of institutions where the frequency of poor repayment rate outcomes is greatest, right? So that's the justification. The department has said, you know, during the negotiated rulemaking, a number of people, when we talked about this, indicated that it would be quite an administrative burden. So we've decided we will only place that administrative burden on the sector that likely has or is likely to have the poorest repayment rates. The department then takes the position that based on its projections, because of course these rates have never actually been calculated, but the department sort of taking its proposed methodology has indicated that it went back and ran some numbers using some old NSLDS data. And they have said based on these projections, 0 and negative repayment outcomes are endemic to the proprietary sector, but are relatively rare in the public and nonprofit sectors. All right, so points of concern. One of which, and I'm going to get to it in a minute, of course, is that really true? First of all, how significant can the student need for this rate be if it is outweighed by the administrative burden associated with the proposed reporting and disclosure requirements? I think it's worth taking a step back here and saying, you know, the department builds this case for why this new information is so important and why it is so critical that students have the best information that they can have, and that they talk about how this is a monumental decision where you want to go to school, right? So it's really critical that they have this information. And then they basically take the position, yeah, but if it's a public or private nonprofit school, you know, the administrative burden is significant enough that even if that school had a terrible repayment rate, the administrative burden would outweigh the students' need to have this information. I mean, that's essentially what the department has done. You know, that's hard to swallow. Right, and I'm not picking on public and private nonprofit institutions. They're not the ones that made this argument, right? It's the department making the argument, and it's hard to understand if the need is that significant, how it could be outweighed by the administrative burden. The other thing that's worth noting is in this case, while yes, it would be a burden, the burden is relatively light compared to many of the burdens already placed on institutions. I mean, certainly when you talk about the gainful employment framework in general, or all the requirements that come along with, you know, campus crime reporting or reporting iPads on an annual basis, or all the other surveys and disclosures and reports that you make. Here, the department calculates the rate, right? You have an opportunity to trade some notes with them as to whether or not you think that rate is okay or the list on the cohort is okay. And then you have to make a 1- or 2-line disclosure on all your marketing materials, et cetera. Now, again, I'm not making light of that, but it's just interesting that here administrative burden has been a justification, where in the past where you've had much greater administrative burdens, it would seem that it has not been. What is the rationalization for basing an exemption scheme on a sector? And I don't mean the proprietary sector in particular, although I will get to that next, but just in general, what's the rationalization for basing an exemption on sector? The justification for the repayment rate is the student's need for the information and the learning, right? So a student's need is a function of institutional performance, not sector. And what do I mean by that? I mean, if an institution has poor repayment rates, it becomes increasingly critical that the student be made aware of that. If the institution has great repayment rates, it is less important that the student get some sort of warning or be made aware of the repayment rate, right? So the need for the student to know increases based on how good or bad the repayment rate at that particular institution is. It has nothing to do with whether it pays taxes or not, right? So any exemption should turn on institutional performance, right, not sector. I mean, that would just seem logical, and that's not a hard thing to do. I mean, just off the top of my head, I've suggested you could exempt institutions that demonstrate strong year-over-year rates for a period of time. So you say, you know, anyone who's had a repayment rate of, you know, 50 or better, or however they end up doing those positive values, but, you know, a certain repayment rate of X over a 5-year period doesn't have to calculate rates for the next 5 years or something like that. But then it's tied to institutional performance, which again makes sense because the need, which is what's been identified as the basis for this rate in the first place, the need is a function of institutional performance. It's not a function of sector. What is the rationalization for dividing institutions up by tax status? And by that I mean, you know, public, private, nonprofit, and for-profit. So why pick on the proprietary sector in this case? And I'm not getting yet to, and this will be the last piece, whether or not the claim is true about the proprietary sector's performance. What I'm really saying here is, why wouldn't you divide it up by, say, all 2-year schools or all 4-year schools, right? I mean, why are you doing it based on control or tax-exempt status? What's interesting is the department seems to have just taken this for granted, right? I mean, when they did their analysis, they even did their analysis based on control. So it's not clear that they even contemplated whether or not slicing the deck, so to speak, in a different way would have been more sensible. And I'm going to get to that in a few minutes. But Ed appears to have conducted their preliminary analysis based on tax status, right? And would it not have been more sensible to divide institutions into sectors, say, based on mission, level of offering, meaning, you know, 2-year degree, 4-year degree, geography? So, you know, if you did the same analysis and you said, we want to see what repayment rates look like by zip code, I think that'd be very interesting. What you might find is that without regard to whether you're public or private nonprofit or proprietary, schools in certain zip codes have very high repayment rates and certain zip codes have very low repayment rates. Or historic CDR performance, right? I mean, repayment rates and cohort default rates aren't the same thing, but they are related, right? Default is a major component of both. Why not look at historical CDR performance and cut things up that way? But it's just interesting to me, and the department really hasn't provided a rationalization for why, or at least it did not, why it started by doing its analysis, and apparently only did an analysis based on control structure and not taking into account maybe different types of variables. All right, so finally the million-dollar question, is the proprietary sector really far more likely, this is a quote, far more likely to have poor repayment rates along with lower post-college earnings and higher default rates than public or nonprofit institutions? Interesting. So I can't answer this conclusively, but what I can talk about is what the department sort of cited, and then some of the other information that's out there. And the department looked at a Brookings Institution, primarily cited a Brookings Institution report that showed a high level of borrowers in a state of negative amortization at for-profit institutions, and then they cited cohort default rates generally, right? So I want to take these in reverse. Let's start with cohort default rates. The department's 3-year official cohort default rate, and this is for the most recent year, although the new ones are very close to being published, but last year's official 3-year official cohort default rates indicated that the distinction among the sectors is marginal at best, right? I mean, according to those rates, the average cohort default rate for the proprietary schools was 15.8%, while the national average for all schools was 11.8%. Now, 2 things to note here. I mean, one is the 11.8% includes proprietary schools, right? So it's a little lower if you take them out of the national average for all schools. And it is worth noting again that proprietary schools are still higher than the national average, right? But marginally higher, and certainly nowhere near, say, the 30% or 40% that requires action on the part of the U.S. Department of Education. But what's also worth noting is that the two highest cohort default rates among all sectors of higher ed were for less than 2-year private nonprofit schools at 22.4% and 2 to 3 year public schools at 19.1%, right? For both less than 2-year and 2 to 3 year proprietary institutions, the CDR was 17.7%. So when you compare institutions that are offering 2 to 3 year programs, you see a couple of things. One is that the proprietary sector actually has a lower cohort default rate than the other two. Two, you also may notice that all three of those are higher than the national average, which suggests that institutions that are educating or providing 2 and 2 to 3 year type credentials tend to have higher cohort default rates, right? But the salient point here is the proprietary schools aren't coming out the worst in any case, right? Also of note, the total proprietary defaults. So for all proprietary schools, when you look at that national average for proprietary schools, the total number of borrowers that went into default and were part of that calculation was a little north of 235,000. The total just for 2 to 3 year public school defaults, right, just in that public school default up there, the 19.1%, was 173,000. The reason I highlight this is because, you know, it would be easy for someone to throw up these percentages and it turned out that there was a very small number of actual individuals part of one of these calculations, which would be misleading. You know, I want to highlight the fact that that category of 2 to 3 year public schools with the 19.1% CDR, I mean, that's 173, nearly 174,000 students, right? So that's not a small number of actual students. In fact, it approaches the size of all of the defaults for all proprietary schools, right? So that's a very real and meaningful number in terms of how many students are affected. So that's sort of on the cohort default side. I mean, in the least, it's a mixed bag, right? It's hard to see how you could argue that when you're looking at cohort default rates, poor rates are, to use the department's terminology, endemic among proprietary institutions and rare among all the other institutions. The CDR data seems to show, again, at best, a mixed bag, right? The distinction in the rate of negative amortization also is fairly minimal. So an institution's repayment rate, which we've already covered, we talked about this, under the proposed methodology will be significantly impacted by the number of borrowers with loans in a state of negative amortization. And I'm going to show you in a minute that's becoming an increasingly high number of borrowers who are graduating from all different types of institutions. And that's a big part of what the department's trying to capture here. They want to get people not only who are in default, but also people who are in a state of negative amortization. But the truth is, since the department began promoting income-driven repayment plans, you've seen a dramatic increase in the number of borrowers in all sectors who are in a state of negative amortization. According to the same Brookings Institution study that's cited by the department in the Federal Register in support of the proposed rule, the percent of borrowers with loans in a state of negative amortization after 2 years was 74% of proprietary institutions, which is high and not great, right? I mean, we'd like to see an improvement in that number, although as long as the department's promoting income-driven repayment plans, that's going to be tough. But it was 64% at 2-year public and private nonprofit institutions, 59% at non-selective 4-year public-private nonprofit institutions, and 48% at somewhat selective public and private nonprofit institutions. And those categorizations of selective and somewhat selective, that's the Brookings Institution's own categorizations. But the critical, a couple of points here, right? I mean, one is the distinction in these percentages. You know, the department uses this language, endemic among proprietary institutions, rare among everybody else. It's hard to see how, given the cohort default data we just looked at and the way these percentages lay out, how proprietary institutions would end up so much further out with these terrible repayment rates as compared to everybody else. Right? The other thing that seems pretty clear is the data suggests that cohort default and repayment rates are much more likely to be impacted by, or in other words, be a function of, the degree level offered and the selectivity of the institution, and not on tax status, right? So in other words, if you're a 2 to 3 year institution or a less than 2 year institution we saw a minute ago, you are more likely to have a higher cohort default rate, right? And the rate of students in negative amortization increases, generally speaking, the less selective the institution becomes, right? Which for 2-year public and private nonprofit institutions would be not very selective, and again with the credential level. And institutions that are not selective and have a 2- and 3-year associate degree type credential levels also make up a large number of proprietary institutions. So it begs the question, Again, in addition to all the other things we've talked about, why does it make sense to single out the proprietary sector? You know, why wouldn't you be doing your analysis if you're the department and looking at this kind of data and saying, you know, where it really looks like the problems are most significant is among institutions, and this isn't surprising, we can all imagine reasons why, that are non-selective, that are generally open, and that offer career and technical two-year degrees, right? But even beyond that, then there's the question that we talked about earlier, which is why would you single out a sector anyway? Why not just make any type of exemption scheme based on the rate performance, regardless of the type of institution? And then taking it even another step back, is this repayment rate even useful information in the first place? So, you know, one could argue that this rate should apply to all different types of schools, that there's not a good basis for singling out proprietary schools necessarily, but even more generally, I think there's a good argument to be made that there's not really a place for this rate, right, and that it's not really going to provide particularly useful information to students. Now, you know, there are arguments to the contrary. There may be consumer advocates that can provide data, or the department can provide data that suggests to the contrary. You know, I'm not suggesting one way or another. Really, I'm just trying to reflect on the fact that a number of the assertions made and some of the justifications made seem to be at least than sound or less than sound and require some additional discussion, I think. A reminder, once again, we'll put out information and on the final reg webinar series that we plan to do in November, December. By the way, also in the feedback, someone asked if we would consider doing a webinar on the new distance education rules proposed by the department. I don't know if we'll be able to do that. The plate's pretty full, but we just put out a blog post on that today, on that topic. So Regucation, which is our blog, if you don't get the email, let us know. I'm happy to send you the emails. And if you don't get it, you can always just come to the website and see it there. But we talk all about the proposed distance education rules on that post today. And there's the link to Regucation. We're always happy for you to check that out. That's me. So let's look at questions. How is proprietary defined for purposes of this proposed rule? Is it strictly applicable to for-profit entities? Yeah, so that is a concept that is actually embedded in the Higher Education Act. It distinguishes between institutions of higher education and proprietary institutions. Those are two different defined terms, and proprietary institution is one that is not a 501c3. So the only way you are a private nonprofit or public institution is if you are a 501c3 essentially, or chartered as a public entity. So yeah, it's anyone who's not a 501c3. For the assigned repayment rate, assigned values, will they be rounded up or down from the percent change? Yeah, I don't know. The department hasn't provided that information. You know, I don't know if they'll round it, and I don't know if they will represent it as whole numbers, you know, instead of 0.17 like I did. You know, I don't know how much difference any of those things will make. I suppose the rounding could make a little bit of a difference if somehow it's getting you above zero. But remember, the question is just, is the median number 0 or negative? Right? I mean, that's it. So it's not a matter of it's not like a composite score where it makes a difference to be, you know, 1.6 instead of 1.5 or however you want to look at it. Here, it's just, are you greater than 0? So the only time a rounding would have an impact is if somehow it shifted your median above 0. And I'm not sure when that would be the case, as long as you're treating all the numbers similarly. Can you please describe the treatment of consolidation loans and the difficulty of calculating the repayment rate when the payments on the loan can't currently be tracked back to the underlying loan? Interesting. Wow. So this is the biggest difficulty we're having when trying to project a repayment rate using this methodology. And since some consolidation loans include loans from more than one school, the balance always looks larger than what was borrowed from one school. Interesting. All right, so can you please describe the treatment of consolidation loans and the difficulty of calculating the repayment rate when the payments on the loan can't currently be tracked back to the underlying loan? You know, that's a great question. I can't, and I don't believe the department discusses this at all in the commentary to the proposed rule. I mean, I was just reviewing that again today, as you would expect. So if they did, I have missed it, certainly possible. But I'm not sure that I've seen them discuss that. You know, my expectation would be that the department would attempt to break those apart and so that it could, do the original balance versus current balance calculation on a loan-by-loan basis. And it may or may not be that institutions have that information available, sort of like with gainful employment. You may not have all the data you need if you want to model and project the rates. But I am speculating, and that is a great question. It will be interesting to see whether or not the department, as with gainful employment and a lot of other things, starts getting questions and as a consequence has to start providing some clarifying guidance. And this is assuming this entire repayment rate scheme shows up in the final rule. I'm inclined to think, and historically the department has typically made only smaller changes, but for example, the proposed gainful employment rule included program level CDRs as an eligibility criteria, right? And during the process between the proposed rule and the final rule, the department determined, no doubt after getting a lot of political pressure, to drop that. So schools still will have program level CDRs calculated, but they don't go to the eligibility of the program. Well, that was a pretty big change. So, it does happen, and it could be that you could see this repayment rate structure change dramatically or even fall to the wayside. But given the way the department has been moving these days, I would be surprised if that was the case. But hopefully we will see some additional guidance, and that's a great question. I'll see if I can figure out an answer after the webinar. I think that's our last question, so thanks as always to everyone for tuning in. I really appreciate folks who've stuck with us for all 4 sessions during the series. Keep an eye out for future webinars, and go to Education and check out the blogs, and we look forward to connecting with you again soon. Bye.